This week, the government released their report on consumer prices for April, and the numbers were a bit worse than expected. Federal Reserve officials fell back to their go-to buzzwords of base effects and transitory. Today, we're going to look into whether those words hold up to scrutiny anymore and ponder the question, is there such a thing as transitory hyperinflation? Let's get into it. The CPI report from the Bureau of Labor Statistics that was released this week showed consumer inflation coming in at 4.2% on a year-over-year basis. This rate of inflation came in higher than the expected 3.6% and sent stock averages tumbling and pushed bond rates higher. Federal Reserve Vice Chairman Richard Clarida acknowledged the higher than expected inflation numbers, but largely downplayed the significance and continues to see these trends as transitory. The other buzzword we heard about a lot lately, base effects, were blamed as well in mainstream media outlets like CNBC. We're going to look at both of those terms today and put them to the test. We'll start with base effects. We talked about what they mean by base effects in our video on the Consumer Price Index last month, so be sure to check that out for a more detailed explanation. I'll leave a link to it in the description down below. Basically, it has to do with the big fall in prices at this time last year due to shelter-in-place orders at the start of the pandemic, which makes the year-over-year comparison look really big. As we did last month, we have a method to strip out this effect to get a sense of the actual underlying trend. Here we have the Consumer Price Index level over the last 2 years, and you can see the big drop in prices from last year. Now, we can create a scenario where this price drop never happened and then calculate our year-over-year comparison from there. When we do that, we see that prices still rose by 3%, which is an acceleration over last month's estimated 2.3% on a base effect corrected basis. So we can clearly see from this that base effects have nothing to do with the latest inflation trends, which are accelerating in the wrong direction. Now, we'll look at the other term that's thrown around a lot, transitory. This basically means something that is temporary, something that's not permanent. What kind of things might they be referring to, you ask? Well, there's been a lot of news lately about shortages across the entire economy, and it's been pretty comprehensive. Everything ranging from lumber to spicy chicken sandwiches to computer chips as well. There are a variety of reasons for these shortages, but a common thread in many of them has to do with the pandemic. A lot of producers shut down last year and manufacturing workers were laid off or otherwise weren't working. A lot of people thought there was going to be a prolonged economic downturn and were trying to cut costs and didn't want to hold finished products in inventory. They didn't expect aggregate economic demand to bounce back as fast as it did. And now they're trying to catch up. The Federal Reserve's thinking on this is that these are transitory price increases from temporary supply shortages, and that when supply catches up to demand, the inflation rate will calm down. Now, that's a possible scenario, but it relies on everything unfolding perfectly from here on out, which is a dubious proposition given all the wild events 2020 and now 2021 have been throwing at us. The problem is that we are in a very vulnerable situation where any more supply shortages can have severe and rapid consequences. Take the recent cyber attack on the Colonial Pipeline that transports nearly half of the East Coast fuel supply. The multiple-day shutdown had a big impact for the people on the East Coast, and panic buying of gasoline set in. There is a psychological impact to inflation, and if people worry that they won't be able to get what they need, they'll rush to get it now. We saw it in the great toilet paper panic purchases of last year, and we're seeing it now. This type of behavior then rapidly exhausts supply and pushes prices higher, and we get even more inflation. The Federal Reserve and Congress made a critical mistake with all the money printing and stimulus measures. They pumped up demand by distributing trillions of dollars to consumers, businesses, and investors, but they didn't make sure there would be enough supply to meet the increased demand. They literally created a situation where there were too many dollars chasing too few goods. It doesn't matter how much money you give out if there aren't enough goods to spend it on. The supply shortages alone would have pushed up prices, but all the extra dollars that have been created have been pouring the equivalent of gasoline on a fire and expecting it won't get bigger. Now the Federal Reserve is in damage control mode and is trying to manage expectations so we don't get panic buying of goods before higher inflation sets in. If inflation is at 5% and accelerating, which is likely to happen in the next month or two, given current trends, can they really say with a straight face that this is just transitory and not a real problem? The Federal Reserve has backed itself into a dangerous corner. If they admit inflation is a problem, pull back on the money printing, and raise interest rates, the stock market would likely face a serious correction and bond rates would soar. If they keep money printing going to fund trillion-dollar stimulus packages coming out of Congress that never seem to end, we're going to have a serious inflation problem. If it gets out of control, will they try to tell us that we'll just have a little bit of transitory hyperinflation? There are a lot of definitions of hyperinflation you can find online. I'm going to stick with the one in my economics textbook here on the shelf, which describes it as a 20% increase in overall prices per month. The CPI from March to April was just 0.8%, so we're miles away from it at this point. But if they don't stop pouring gasoline on this fire and address our supply problems, it is a potential reality. I believe this message is important for people to hear. We're a small channel here trying to grow, and YouTube is pretty crowded with people trying to get their message out. If you think this message is important for others, please share it on social media or text or email a link to this video to others. You can also give this video a thumbs up and post in the comments section down below. Those actions help this video get picked up in YouTube's algorithm so that it gets into people's recommended feeds and they can get the same information that you do. Thank you for all your support, and I'll see you in the next video.